Welcome to the Deep Dive. Today, we are strapping in for a detailed look at specialty retail.
Yep, focusing specifically on Haverty's. That's ticker HVT.
Exactly. We're tackling their latest earnings report. The numbers, well, they showed a clear inflection point, something investors usually like.
Right, but the market reaction was, let's say, stubbornly negative.
Which is why we're here. We need to figure out why that contradiction exists. What's really going on under the hood.
Okay, so the results we're covering are for Haverty's second quarter 2025. These numbers dropped after market close on July 30th.
And the all-important conference call happened the next morning, July 31st.
That's the one.
And this quarter, it feels like a real mile marker. Haverty's actually achieved its first year-over-year sales growth since way back in the fourth quarter of 2022.
It's a significant shift, especially considering the tough environment they're operating in.
It really is a massive narrative shift. But here's the kicker, right? The stock finished the day down 3.3%.
Oh, yeah.
So you have this major operational victory on paper.
That seemed completely dismissed by investors. It suggests there's some serious underlying skepticism we really need to unpack.
Definitely. So let's lay out the headline financials first. Because look, on the top line and the bottom line, they delivered a solid beat against the consensus estimates.
Okay, give us the numbers.
All right. GAAP earnings per share, it came in at $0.16. That comfortably beat the street's expectation, which was sort of in the 0.145 to 10.15 cents range.
Okay, a clear beat there. And revenue.
Revenue also surpassed estimates. They reported $181.03 million against a consensus of about $177.11 million.
And that produced the sales growth you mentioned earlier.
Exactly. That's the 1.3% year-over-year growth. First time in a long time.
A beat on both metrics, that should signal health, right? Especially now. And there was one figure that just on its own suggests really amazing operational discipline.
You thinking gross margin?
Yeah, the gross margin. They hit a really robust 60.8%.
Which is up 40 basis points year over year. It's not easy to do. Not at all. That number should be celebrated. It shows they're maintaining pricing power, managing costs, even with all the supply chain noise and everything else.
It's a tremendous feat, no doubt. Shows real merchandising strength. But, and it's a big but.
Uh-oh. Here it comes.
That strength was immediately overshadowed by the two core pressure points that, sent the stock lower.
Okay, what were they?
First, comparable store sales comps. The metric investors watched like hawks for existing store health.
Right.
They were down 2.3% year over year. That's a clear red flag for many.
Okay, negative comps, not great. What's the second point?
Selling, general, and administrative expenses, SG&A. They rose pretty sharply, clocked in at 59.3% of sales.
And where was that compared to last year?
Up from 57.7% a year ago.
Okay, so let me just simplify that second point for everyone listening. They're basically spending money faster than they're making it on a proportional basis.
That's a good way to put it.
That rising expense ratio, the SG&A deleverage, that's what spooked the market, right?
Precisely. They're essentially paying more to generate each dollar revenue right now, not the direction you want to see.
Okay, let's try and unpack how management is navigating this really difficult trade-off then. They acknowledge the headwinds, right? Soft housing market, consumer confidence kind of low.
They did, but they insisted on highlighting two internal victories. First, they said they had consistently positive traffic trends coming into their stores.
Positive traffic, okay. And second,
significantly improved conversion rates. Basically, they're getting better at turning those browsers into actual buyers.
But wait a second. Why is management celebrating positive traffic if the comps are still down 2.3%? Isn't that just, vanity metrics unless they translate directly to same-store sales growth?
Well, that's the friction point, isn't it? The management narrative suggests their internal execution is winning or starting to win against that macro weakness. And the underlying results, they do back up stabilization. Maybe not explosive growth yet, but stabilization. Total written business, which is like the order backlog for future sales.
Right. Orders taken but not yet delivered.
Exactly. That was actually up 0.4% in the quarter.
Okay. Slightly positive.
But what's really interesting here is the cadence, the timing within the quarter. Written sales started down 2% in April.
Okay.
But then moved to being up almost 1% in May. And then jumped again, up approximately 2.5% in June.
Okay. Now, that's interesting. That sequential improvement, that's the foundation for their claim that things are, turning around.
It really is. It suggests momentum was building right through the quarter end.
And it seems like the top-tier consumer isn't really phased either. The overall average ticket stayed strong, right?
Yeah.
Just under $3,400.
Yep. Very solid. And even more critically, their specialized designer average ticket grew. It was up about 5% to over $7,600.
Wow. And that higher margin business, that design stuff, that's exactly where the tariff volatility probably hit hardest, right?
It was a huge disruption for them. They confirmed on the call they had to implement a temporary suspension of special order capabilities from China.
When was this?
Back in early April. It was triggered by that proposed, absolutely massive 145% additional tariff that was floating around.
Yikes. So they just shut it down temporarily.
Had to. It directly impacted that high-end design segment. But the good news is, some clarity arrived in mid-May.
What happened?
The tariff was officially reduced. It landed at 30%, not 145%.
Okay, still significant, but way better than 145%.
Exactly. And management expects to be fully operational again on that front in Q3. This is really critical because that special order design business, it was down mid-single digits in Q2, largely because of that freeze.
Right. So that segment has sort of built-in Q3 acceleration just from removing that operational roadblock?
Precisely. That timing means that lost business or delayed business should feed right into the next quarter's results.
Makes sense. So how is Haverty's defending that impressive 60+% gross margin against this ongoing trade policy uncertainty? Are they just eating the cost?
No, they seem to be maintaining a defensive pricing stance. Management stated pretty clearly they are prepared to adjust pricing to offset potential future tariff expansions, specifically to defend the margin. And the fact they maintained their current full-year gross margin guidance still holding at 60.0% to 60.5% despite all this uncertainty, well, that's a strong signal.
Yeah, signals confidence in their ability to pass costs on, or maybe source strategically, or both.
Could be both. Yeah. And just quickly, regarding what customers are actually buying, upholstery and bedroom were the stars. Low to mid-single-digit growth there.
Okay. And the laggards?
Dining room and decor were the weakest categories. Both were down high single digits.
Got it. Okay, let's shift focus entirely now to that SG&A spike, because that feels like the primary concern for the market, right? We need to know where that $4.2 million increase actually went. Was this necessary investment stuff to fuel that sequential growth you mentioned, or is this just, operating bloat setting in?
Management did detail that. They said the increase was primarily driven by three main things. Higher advertising spend.
Makes sense if you want traffic.
Increased occupancy costs, so rent, basically.
Rent inflation.
And administrative costs. It does align with their strategy of, pushing harder on marketing to drive traffic in a soft environment.
Okay. I see the need to spend on marketing for sure, especially to maintain traffic when the housing market is basically dead. They specifically noted an extra $1.1 million went towards promoting that competitive 60 months no interest offer.
Right, a big headline promotion.
But what's kind of counterintuitive and really fascinating here is that even though they pushed credit aggressively, they didn't actually see an increase in credit usage. And in fact, their overall credit costs decreased by double digits.
Oh, that's interesting.
Yeah. So they got the competitive edge, they got the traffic boost from the promotion, but without the expected associated expense hit. That's pretty sharp execution.
That really is. And, that leads us to what I see as maybe the hidden gem of this entire call, their digital playbook.
Okay. Tell me more.
Well, first, the loyalty email campaign was really successful, generated about $17 million in Q2 alone. Year to date, it's over $25 million from that.
Wow. Okay, that's real money.
But the true game changer, I think, was the tech side. They converted their product and listing pages to Adobe's Edge delivery service in June.
Adobe Edge. Okay, some kind of back-end website tech.
Exactly. It's about speed and performance. And this tactical change, made mid-quarter, immediately led to a massive 15.6% increase in organic traffic.
Whoa, hold on. 15.6% organic traffic boost? From a tech switch?
That's what they reported. Well, and it translated directly into 8.4% web sales growth for the quarter.
For a legacy furniture retailer, that kind of organic lift, that fundamentally shifts the dynamic of their sales channel mix. That's pure leverage they just unlocked.
It feels significant, doesn't it?
It really does. Okay, moving to the balance sheet. How disciplined are they with capital? And maybe, why aren't they expanding faster if they have this much operational momentum and this digital lift?
Well, their balance sheet is, frankly, a fortress. It's a key differentiator in retail right now.
How so?
Zero funded debt. None. Plus, $107.4 million in cash sitting there and $80 million available on their revolver if they needed it.
Okay, very strong position. CapEx plans.
They confirmed capital expenditures remain firm at $24 million for the full year 2025. But you hit on the right skepticism about expansion.
Yeah.
They're managing expectations. They're shifting some planned 2025 openings into 2026, specifically mentioned St. Louis Fenton and Nashville Mount Juliet.
Ah, okay. So the store count stays flat this year.
Looks like it. Ending 2025 flat at 129 stores. And management's commentary was pretty direct on why. They said commercial rents have not gone down.
Right. It's still expensive to build out.
Seems like it. So they're choosing discipline over maybe accelerating expansion right now, even with that strong balance sheet.
So putting it all together, the market sentiment becomes more understandable, right? It was a cautious beat. Revenue topped low expectations, sure.
Right.
But the comps decline, even with the sequential improvement and that rising SG&A expense. It just created a mixed bag that sent some investors running for the sidelines, hence the 3.3% drop.
Yeah, the market isn't rewarding that internal execution quite yet. They want to see the numbers fully flow through, especially on the comp line and the SG&A leverage. It's a wait-and-see stance, maybe.
Okay.
And that wait brings us to the near-term catalysts and risks, things you should probably be monitoring into the fall.
Lay them out for us. Risks first.
Okay, on the risk side, you have to watch that continued SG&A deleverage. Can they get costs under control relative to sales? Second, the ongoing pressure from rent inflation they mentioned.
Still a factor.
And third, of course, the final crystallization of tariff policies. Still some uncertainty there, even with the 30% clarification.
Got it. Now, the potential upside. Catalysts.
Okay, catalysts look pretty specific and time-bound. First, the full return of those special order capabilities in Q3. That should provide a lift.
We talked about that. Makes sense.
Second, the amplified marketing spend around the critical Labor Day event. They're extending the promotion and doing a new direct mail campaign in August. They're clearly pushing hard there.
Okay, more marketing firepower.
And third, and maybe most powerfully, that 15.6% organic traffic boost from the Adobe Edge conversion, that's only just beginning to flow through the P&L, right? It hit in June.
Good point. Q3 will be the first full quarter impact.
Exactly. And one more thing. They have an investor relations touch point coming up. They'll be at the Sidoti Small Cap Conference on September 17th. That could provide some additional narrative clarity for investors.
Okay, lots to watch there.
All right, before we move on, just a formal disclaimer. The following segment contains some hypothetical ideas based purely on our analysis of the earnings call. It is absolutely not personalized financial advice. Please consult your own professional advisor before making any investment decisions.
Okay, disclaimer noted. Let's get specific then with our "this is not financial advice" idea. The setup here feels pretty clear, right? The market is, I think, myopically punishing HVT for those soft comps and the very visible SG&A bump.
Focusing on the negatives.
While completely overlooking the pristine, debt-free balance sheet and, maybe more importantly, the operational blocking and tackling success they're having. The conversion improvement, the huge organic traffic uplift, the margin defense.
It's stuff that takes real work.
Exactly. The street seems focused entirely on lagging indicators right now.
So what's the play? You're thinking we make a leveraged bet on a fundamental operational turn that the market isn't pricing in.
Exactly. We propose going long, maybe just a modest amount, of out-of-the-money call options, let's say expiring after Q3 earnings are expected, which should be around the end of October, maybe early November.
OTM calls. Okay. What's the rationale? Why will that work?
The rationale is simple, really. It's about the convergence of three powerful internal factors that are set to hit in Q3.
Okay. Lay them out again.
One, that special order business fully resuming after the tariff mess. Two, the successful Q2 marketing campaigns being amplified even bigger for the crucial Labor Day event.
Right, the extended promotion, the direct mail.
And three, the full quarter impact of that massive 15.6% organic traffic boost from the Adobe Edge conversion finally hitting the numbers.
Okay, so the combination of those three.
Right. I think that combination is going to surprise the market. It could drive same-store sales back to positive growth much sooner than the street anticipates.
This could trigger
a significant short-term move, maybe a short squeeze if there's enough negative sentiment built up, or just a re-rating once those potentially better than expected Q3 numbers actually hit. It's basically an acceleration story hidden beneath all the macro noise and the Q2 SG&A figure.
It's a compelling argument. Definitely based on internal execution, potentially outpacing those broader sector expectations. Okay, so just to recap the core narrative of this entire deep dive then.
Bring it home.
We saw strong resilience, particularly in gross margin and their ability to generate traffic. That was coupled with really disciplined capital management. Zero debt is key. All while the company navigates a highly complex and, frankly, uncertain macro environment.
Well put. And here's the provocative thought I want to leave you, the listener, with today. Given that 15.6% jump in organic traffic and web sales growth, driven specifically by their digital platform changes with Adobe Edge,
Yeah.
how much leverage does Haverty's now have to drive sales independently of the traditional housing turnover cycle? Is their increasing digital efficiency becoming the key to maybe, just maybe, decoupling their stock price from whatever the Fed decides to do next? Something to think about.
Definitely something to mull over.
All right, that's all the time we have for this deep dive. Thanks so much for joining us, and we'll catch you on the next one.